Hi, so we are going to discuss something very interesting today. It's about profit to earning ratio, also known as PE ratio. I'm not going to teach you what is PE ratio, so I will suggest you to read about it or watch some videos, how the PE ratio is calculated, and then come back to this video. So let's start with companies who are in their mature stages, a very large cap, the blue chip, and they have very high PE ratio or very high profit to earning ratio. These kind of companies do not have any margin of safety. So just to give you an example, let's suppose a company who's a very large is doing relatively very good sales with decent profit margin and you are giving its price multiples of 100 means its PE ratio is 100. So to justify this PE ratio, the company should grow very fast, which it cannot because it's already in the very mature stages of the company. The company already occupies the majority of the market. As these companies do not have any margin of safety, you will not find any stop loss which will help you there. Once they start missing their profits or their earnings, it will keep falling. The current example of these kind of stocks are HUL and Asian Paints. They used to be the darlings of investors, stock market gurus, PMS fund managers, especially the HUL and Asian Paints. And you can see what is happening right now. They are not growing as much as they were before. Their margins are in pressure, and with the entry of new players, their market share, even their moat is in threat right now. So what will happen in these kind of stocks? They will not give returns for multiple years, or worse, they will give negative return for multiple years. Because their PE ratio means they're too expensive even in this kind of market where you will find the bottom in these stocks until unless they pick up the same sort of growth as they were when they were demanding high multiples, you will not see any bottom. It will keep falling. So these kind of stocks are very dangerous for your portfolio. Let's talk about the company, which is fundamentally solid, high growth, and solid profit margin. And somehow you stumbled upon this company when its valuation is very abysmal, means it's available at a very low PE. This is a golden opportunity. Until and unless it's a black swan event, means the company might go bankrupt. A bad performance of one quarter or a 1 year can be a golden opportunity for you to jump in that kind of company. So let me give you the example here. Let's go back to 2020, the corona pandemic. You have seen the market falling in March. Within 2 to 3 months, market went high. Everybody was earning so much money, but there was one stock which had 2.5% return in 2 years post that crash, and that stock was ITC. It was center of attention on social media. Everybody was bashing this stock, and people were saying even FD can give better return than ITC. But mind you, I told you one thing: fundamentally strong company, decent growth with solid margin. ITC went down below 150 at one point of time in 2020. It was available at less than 12 PE. So did you have courage to buy the ITC at that time? Because that's the golden opportunity. We did, some other people did that too. And since then, ITC has given 4 times return to their investors. Let me give you another example, not from India, but from the company which touches life everywhere. I'm talking about Meta, which is also known as Facebook. In 2022, Facebook, the stock price fallen from 300 odd dollars to $90, which is 73% drop. Why did it happen? The company's revenue fall little bit, margin took a hit little bit, and there was problem with their AR VR version, which people were not very convinced about, and the issue with Apple licensing. So again, what I told you, of a fundamentally strong company with good growth and solid profit margin, it available at a low PE, it's a golden opportunity for you. Facebook was trading at less than 13 PE at that particular point of time, while the company was giving consistent margin of more than 20%, and their growth also was very good. So yes, it was a golden opportunity. We took the plunge. We had to wait for some time, and since then, it's just 3 years. Facebook has given 7 times return to their investors. And last, let's talk about the companies which you should pick when they are trading at a higher multiples. It makes sense for you to pick a company with a smaller size, a smaller cap or a mid cap. If they are giving a very good growth, their margins can be relatively low as well because they are in their early phases of the company, but they have lot more room to go than the mature companies. So if you find a small cap company with a very high growth, relatively moderate or decent margins, and there should be some sort of moat around the business as well. And if that company is trading at higher multiples, you might do your own research to take the plunge at that company, because that company is much better than the company I told you about in the first seconds of the video. So what we learn from this particular video is PE ratio can be very important and can be very deceiving too. You might buy a company thinking they are available at very low PE ratio right now. Their average median PE is at all-time low. But you have to see whether the company has growth and moat around their business or not. So you need to understand the market, the dynamics of the business, and whether the company which is trading at a PE below their median PE, will it bounce back or not? Or is this just some kind of anomaly which happened for a short period of time of which you can take advantage of? Thank you very much.